Washington has the power to change the rules when it comes to retirement. That's why today we're talking about what it means for you. We're going to cover the One Big Beautiful Bill Act, RMDs, how they keep shifting, plus the 10-year rule and what it means for your heirs. It all comes back to why having a flexible plan is so important. Hi, I'm Molly Nelson here with Clint Huntrods and Lauren Merkel, and we are talking about the One Big Beautiful Bill Act because, Lauren, when you sit down with families and individuals and plan for retirement, you're talking a lot about the One Big Beautiful Bill.
Well, because the number one wealth eroding factor when it comes to retirement planning and taking retirement income is taxes. And the One Big Beautiful Bill has an impact on almost everybody's retirement tax situation. The question is what kind of impact is it going to have on you? What implications are in that One Big Beautiful Bill? And how can you use it to your advantage the best way possible to decrease your retirement tax bill?
Let's get right into the bill then and what it means for people. First, the tax brackets. It extended what was already in place, but a lot of times on this show, we talked about those tax brackets and how they're a moving target. What do people need to know about the tax brackets?
Yeah, everybody knows that the bill is big, but is it beautiful? And one of the positive things where you can say there is some beauty to this is that it has extended the Tax Cuts and Jobs Act tax brackets that we will continue to see as we move forward. Should this not have been passed and the Tax Cuts and Jobs Act sunset, then a lot of those brackets would have gone up beginning in 2026. So the 12% bracket would have gone to 15, 22 would have gone to 25, 24 would have gone to 28. And the good news, the beauty of the bill, is that those are going to continue how we've seen them during the Tax Cuts and Jobs Act. That has been extended permanently as well. So until new legislation is passed, which certainly could happen somewhere down the road, those are the brackets you can continue to expect to see.
Yeah, so basically they didn't put a sunset date on these for right now. That's
Correct.
kind of where that permanent comes in. We know that, again, they could keep changing depending on who's in power and what Congress does.
Yeah, and so if you think back, if you take a married filing jointly couple, they've got $394,000, that can get them all the way up into the top of that 24% tax bracket without clicking into the 32% bracket. If you take that same number and take it back pre-Tax Cuts and Jobs Act, that would have put them in the 33% tax bracket. So a very big difference that we've seen with that Tax Cuts and Jobs Act, and for that to be extended is a positive thing for tax bills.
Yeah, there's a big difference in those tax rates, 24 to 33%. Now, some people might be watching and say, $394,000, that's a lot of money. I'm not quite there. So let's dial that number down a little bit. Right now, to be in the at the top of the 12% tax rate, your married filing jointly income would be $96,950. Pre-Jobs Cut Act 2017, that would have that same level of income would have put you in the 25% tax bracket as opposed to the 12% tax bracket. So regardless of what income level you're at, whether you make just a lot of money, a ton of money, or maybe a more moderate amount at the $96,000 level, it does make a difference. And of course, those numbers, those brackets are without inflation adjustments. But it can make a big difference, and understanding that difference and how to plan for it is really the key.
So often as we're walking through those brackets, we go from 12% to 22. And a lot of times families say, well, there should be something in the middle here. Right. To go for such a big jump, that just gets the importance of doing some tax planning to understand where is that threshold at that could click you into the next tax bracket and all of a sudden really drive up as you take taxable income, how much it's going to be taxed at.
Speaking of tax planning, I know when you guys sit down and talk about long-term tax planning, you're talking about this new senior bonus deduction. What do people need to know about that?
Yeah, the senior bonus is probably one of the biggest talking points and biggest things that we're working through families to understand the impact of the senior bonus on their plan. And what the senior bonus is that has increased the standard deduction for individuals who are 65 or older, $6,000 per person. Married couple, you could have up to $12,000 stacked on top of your existing standard deduction, and that is going to make a big difference on any distributions that are coming from taxable accounts, any distributions that are coming from those pre-tax accounts. It also impacts how Social Security is taxed. This is one of those that I think is really kind of getting at reducing how much Social Security is taxed. They weren't able to change that, but this is kind of the way that they've adjusted to help to make sure more taxable income for seniors is going to be coming through.
Also a prime example of how the Big Beautiful Bill added complexity to your tax situation because there's income restrictions in order to obtain that senior bonus deduction. As an example, if you're a married couple, if you make less than $150,000, you get the full $6,000 per individual. But if you make more than $150,000, it starts to get phased out. And if your income as a married couple is in excess of $250,000, now that $12,000, $6,000 per individual does get evaporated and is not available to you. So it adds additional elements of planning, and you have to stay on top of this stuff. Otherwise, that $6,000, $12,000 senior bonus deduction could go away.
And it really impacts if you're thinking about a Roth conversion. Because in a Roth conversion, you're voluntarily taking some money from your pre-tax account, paying the tax bill this year, which is going to push your taxable income up. And then once it's in the Roth bucket, it's going to grow tax-free. But that's something that we're talking through with every family. Our Roth conversion has to include what's the impact of the senior bonus. We recently worked with an individual, and in his case, we decided that it was okay to go past. The limit for him was $75,000 before he starts to reduce how much of that senior bonus, that $6,000 that he would get. And we made the decision, we're going to go past that. We're not thinking about a tax bracket. We're not thinking about that $75,000. In his case, we were trying to get as close as we can to the IRMA threshold at 106 in the particular year that we were helping him plan for this. Because that was the thing that we needed to do to help his plan over the long term. He's got 2 years before RMDs kick in, and he saved jointly with his wife. His wife has passed away. Now he's not in married filing jointly brackets. He's in single brackets, which are going to fill up twice as quick, but they help to accumulate their assets together. So in his case, we were okay with moving past that senior bonus and not really worrying about that as much. In other cases, we're looking to stay under that $75,000 for a single individual, $150,000 for a married couple, to make sure we're not going to reduce how much of that senior bonus deduction that you'll be able to obtain.
And that example right there just really highlights the key to all of this planning that we discuss on the show, but specifically with tax planning, is your plan has to be custom to you, because you might decide to go above those thresholds. Like in this example, you decided to go above the thresholds to stay under the Medicare IRMA threshold, but you eliminated some of the other benefits, but you made that decision consciously. And then therefore, there were no surprises about the level of why you're going to the level you are and what you were giving up to do so. The calculation made sense in that example. But in your example, it might make sense to stay below the threshold, take full advantage of those other deductions. It's case by case, and this is why the customization to planning is so vital when we're talking about all these tax nuances, tax legislation.
And not to make it more complex, but another thing that we were thinking about,
we can't help him.
In his case, was the more he showed for taxable income, the more of his Social Security benefit was also going to be taxed. So you add more taxable income, and now that's changing how his Social Security benefit is taxed. We're thinking about all of that, helping him understand it as we make the decision with all the information in front of us, what's the best thing for his case and his particular plan.
Yeah, eliminate surprises and optimize decision quality.
And I think we should note with the senior bonus deduction, in case you didn't say this, it's only scheduled through 2028. So some of these strategies may not be available in 2029. So we know that Congress changes things. One thing that's been a moving target in recent years is RMDs. Let's remind everybody, Clint, what an RMD is.
Yeah, when we save money in those pre-tax accounts, there is a point where the government says, hey, you've deferred taxes long enough, you need to start to take distributions out and pay some of that tax bill that you've been deferring. And that occurs at 73 or 75, depending on your birth year. And sometimes that's confusing, even across a couple who's a few months apart, they might have a different RMD age. But so that's something that you want to make sure you're prepared for. That's where that ticking tax time bomb can explode if you haven't thought proactively about your tax plan before that.
But Lauren, it hasn't always been age 73 and age 75.
Well, of course not, because that would just make it way too easy. We don't have to go all that far back. I mean, 2018, the required minimum distribution age for almost everybody was age 70 and a half, which means if you obtained 70 and a half, you were mandated to start taking distributions from your pre-tax accounts. And then Secure Act 1.0 was passed, and then that moved it to age 72, and then Secure Act 2.0 was passed a year later, and now it's age 73 or 75, depending upon your date of birth. And this highlights one of the areas that's really problematic from a planning standpoint, because, Clint, how many times do people come to us for the very first time, and they say, my neighbor told me, or my coworker told me that I have to start taking distributions at the age of 75 or 73 or 70 and a half, whatever that may be. And that might be right for you, but it's also possible, maybe even probable, it's completely different because different laws apply differently to people. And this is where, again, the customization really comes into play.
Yeah, and 70 and a half still got held on to when it comes to qualified charitable distributions. So that's really a throwback to what RMD age used to be. And that's something that you find is a way that you can more efficiently give to a charity or a church. And that's something that we help families. Sometimes no one's ever talked to them about that. So just a more efficient way to do what you're already doing, and that will start to satisfy some of those RMD requirements once you reach that RMD age.
And just a quick reminder, the people that set the RMD age are the people in Washington. So that's why we're talking about all these changes today, because a lot of things can change. And another thing that changed in the Secure Act 2.0, Lauren, was the ability to stretch an IRA that you inherited over, I think it was the person who inherited their lifetime. That went away.
That's probably the biggest casualty of Secure Act 1.0 is prior to the Secure Act, let's say you pass away and your $1 million IRA went to your 40-year-old daughter. Your 40-year-old daughter now had the rest of her life expectancy to take distributions out of that IRA. So maybe her mandated distribution might have been somewhere around that $4,000 mark. So whatever income she was making at age 40, let's call it $150,000, she has to take $4,000 out. Now it's $154,000. Well, Secure Act 1.0 eliminated that and now says that your 40-year-old daughter has only 10 years to take that $1 million out of the IRA. And if she divides that equally, she doesn't have to, but if she divides that equally, now her $150,000 of income is $250,000 because she has to take $100,000 instead of the $4,000 out of your $1 million IRA. Changes the game significantly.
Yeah, and sometimes families have seen, maybe they had an inherited IRA before that Secure Act was passed, so before 2020, and they said, oh yeah, I can stretch this. So then when they inherit something new more recently, they think, oh, I can stretch that too, not realizing how those rules have changed, because not everybody's taken notes of all the legislation that's passed. So sometimes when we share that with them and help them understand what that means when they have that inheritance, that catches them off guard.
And good thing is you guys take notes on the legislation and you look into it and you read it and you study, and we send out a lot of communication to the families and individuals that we work with. And just to go back to your example, because you did a really good job of setting it up, but I want to make sure we land the plane, because really the biggest thing on that $250,000 a year is taxes. She's going to pay a lot more in taxes. So the $1 million that her mother tried to pass along to her doesn't have the same impact on her over time.
Yeah, because now it bumps her up into a higher tax rate in most cases, because instead of having a taxable income of 150, now it's 250,000, and probably that way for at least the next 10 years. Because if she takes $100,000 out per year on the million, that doesn't even include the growth on that money as it's being invested, which means her tax bill can be significantly higher, which means the legacy that you leave to your daughter, to your kids, to your loved ones can be that much smaller because more of it goes to the federal government.
And a great thing is when you do implement conversion strategies for Roth dollars, you build more tax diversification across your portfolio, it's going to help you in your lifetime. It'll also, in many cases, help you from a legacy standpoint, because those Roth dollars you can still pass on tax-free. There's still rules on getting those out, but it's different and you don't have that tax bill associated with it. The same thing goes for any assets that you've inherited or that you've accumulated that are more non-qualified or a brokerage type of account. Those are dollars that'll get a step up in cost basis and can pass on in a more tax efficient way. The biggest thing that's impacted are those pre-tax accounts, which so many families save into, because that allows them to be more tax efficient during their working years where their income's higher. But when you start to shift into retirement, you need to make sure you're taking advantage of every opportunity to start to diffuse some of those deferred tax dollars that could have an impact in your lifetime, but also from a legacy standpoint.
And people sitting at home, they may not know all the rules. They're definitely not probably going to read the bill. But you talk to people on these Retire Ready calls, Clinton, they'll say to you, hey, I've got some IRA money and I've got some other money. I know I want to give some to a niece or nephew and maybe some to my church. And you'll say, hey, have you thought about this? And it can be eye-opening for them in just 15 or 20 minutes, the strategies that you can offer in a Retire Ready call.
Yeah, I recently had a conversation with an individual, and she was thinking of how do I most efficiently transfer my assets? I've got a church in mind. I've got 3 nieces and nephews that are out there. And across her portfolio, we talked about it might make sense for those IRA assets to go to the church. That can be a more tax efficient way to give. Them as a nonprofit won't be taxed on that. And then for those non-qualified assets that she'd saved up, that could be great to go to her nieces and nephew and be a much more tax efficient way to, distribute her legacy and accomplish the different goals that she had.
And that's because that type of money they don't have to spend within 10 years. Is that the big advantage there?
Correct.
They can spend that when they're ready and at their own pace,
Yeah,
essentially.
with non-qualified assets, that gives them a lot more flexibility. It's not bound by some of those retirement planning rules.
And in most cases, the nieces and nephews don't pay tax on that money. So in that example, any of the money from the IRA that goes to the church goes tax-free. Any of the money that goes to the nieces and nephews from the non-qualified also goes tax-free. Taking otherwise taxable events, turning them into tax-free, that's power.
We know what happens in Washington can impact your retirement. So, Lauren, anytime there's a government shutdown, a lot of retirees ask, will this threaten my Social Security check or my Medicare coverage?
It's a great question to ask because it is top of mind. If you've recently retired and you haven't taken your Social Security, how does that impact you? If you have elected your Social Security, are you going to continue to receive those checks? What happens from a Medicare standpoint? This is what everybody thinks about as we go through government shutdowns. And it's really important to understand what services stop, what services don't stop, how does the income change or not change as you're going through these troubling times.
Yeah, so we know Social Security so far, generally those checks continue, Medicare coverage continues, but service definitely changes, and you've seen it, Clint, the most recent government shutdown, you've seen it in person.
Yeah, we see that happen, is that there can be lead times that start to build up a little bit more. And we even saw that back during COVID days when a lot of people, there's just interruptions to the service when it comes to getting someone to help you and answering your questions when you call in, getting them to call you back, or even the website that maybe you're using to file can be slowed down or crash entirely.
The recent Medicare or the recent government shutdown coincided with Medicare annual enrollment. We have a director of Medicare and long-term care. She helps people with those decisions that you have to make each year when it comes to Medicare. And she told all of us that that was a very challenging time during that annual enrollment.
It wasn't fun for her because, and she said she was working nights and weekends because during the day that website just didn't work. There were so many people on it. It wasn't staffed well, and the website just was not functioning. So it was troublesome for her, but more troublesome was all the families and individuals that she was trying to help go through that Medicare maze. Those for the first time, those who were trying to make changes to their existing Medicare. All of that is problematic for everybody who needs and wants Medicare. There's not much you can do about the government website, but there is a lot that you can do about your plan, trying to plan ahead. Government shutdowns have taken place since 1976 when this current legislation was put into place, and they will continue to take place as long as the current budget legislation is in place. So it's a matter of how do you acclimate your plan to the inevitable, even though the inevitable is not something that really we want to take place.
Yeah, and sometimes maybe 3 months in advance before filing, before needing Medicare to start, we want to start that filing process. Now we might be moving it back 4 months ahead of time, and we just help families through that because we do it every day. We know what those lead times are going to be like, and we will help you adjust and make sure that we're doing everything we can to keep from having any sort of interruption to getting those benefits to start when you want them to start.
Let's talk about the markets, because whether it's a government shutdown, a tariff, a global conflict, an announcement from Washington can often make the markets do. Can I do this?
Yeah.
Does that work? This.
Or sometimes like this.
Yeah, or even steeper. And that is concerning for a lot of people, but especially those are 55 or older.
Well, you've worked for 40 years, you put money in diligently into your retirement accounts, and all of a sudden some news comes out of Washington on no fault of your own, and you see your 401k balance drop by 20%, 30%. That's troubling. That's troubling, and it feels very powerless because you didn't do anything and you're just watching your hard-earned savings evaporate. The good news about the investments and your portfolio is you can do something. See, the retirement years are substantially different, and the pre-retirement years are substantially different than your working years, where in your working years, you just want to put money in. And when the market went like this, it actually helped you because you were buying shares at a lower price. Now you have to really protect, you have to preserve and turn that portfolio into income, which means your investment style needs to change. What got you there isn't going to get you to and through the next phase of your life, which is retirement. And this is a primary focus of our team as we're looking at what your portfolio risk is, how are you invested, what are your retirement goals to make sure it all aligns. So when bad things happen to the market, Washington likes to chirp, when bad things happen, it doesn't have to happen to your portfolio in your retirement.
And I recently had a Retire Ready call, and someone was asking, because interest rates are coming down, they were using CDs as a really big framework to their investment plan. And they're saying, I just can't get the return that I was previously getting. And they needed to start to think through what other strategies are out there. They had leaned maybe too much for safety and protection, and then they're in danger of not being able to keep up with inflation and taxation over time. And they needed to really start to think beyond just maybe some of those CD type strategies. Another big question that she had was about making her Social Security decision. And so we were able to talk through the pros and cons of starting that right at 62, or in her eyes, do I wait until 65 and I can get $500 more per month? She's currently working part-time, so if she turns that on, she'd be able to enjoy more time with family, not have that weekend job that she's previously had.
And that right there is one of the main reasons we offer that Retire Ready call, because within just a quick 20 minutes, you were able to offer her some really meaningful guidance. But I think also more importantly is one of the hardest parts about retirement planning is how do you get started? What is a plan and how do you get started? So not only did you offer her guidance, but then you were also able to help her get started with one of the most challenging aspects of planning, which is what's the next step? How do you actually develop this plan and customize it to her situation?
Guys, one thing I know, we cannot control what happens in Washington. We can vote for leaders, but we cannot control the laws that are made in Washington. You know what we can control, though, is your retirement plan. Right now, you could schedule a Retire Ready call. Get started building a retirement plan that stands up to whatever happens in Washington. Go to retirereadycall.com. This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.